Every major financial collapse of the last century, 1929, 1987, 2000, 2008, was not an accident. It followed the same invisible sequence, step by step, long before the headlines, long before the panic, and long before ordinary people lost everything. This pattern appeared months, sometimes years, in advance. Wall Street saw it. Central banks tracked it. The families who managed generational fortunes prepared for it. But the public was never meant to understand it, because if they did, they would exit before the collapse, not after. Before we go any further, subscribe to Gilded Old Money, because this channel exists to uncover the financial truths the elite quietly act on while everyone else is distracted by noise. In 1929, one man broke the silence. His name was Roger Babson. At a packed business conference, he calmly warned the financial elite with a single sentence that would make him a pariah overnight. Sooner or later, a crash is coming, and it may be terrific. The room laughed, newspapers mocked him, and America's most celebrated economist, Irving Fisher, publicly assured the world that stocks had reached a permanently high plateau. 47 days later, the market collapsed. Fisher lost everything: his wealth, his credibility, his future. Babson did the opposite. He preserved his capital, acquired hard assets, and quietly built a fortune while the world burned. History remembers the crash. What it forgets is why one man saw it coming. Babson wasn't guessing. He wasn't lucky. He was watching a sequence, a 5-stage financial progression that appears before every systemic collapse. Credit expansion, risk concentration, silent exits, vanishing liquidity, and finally, a trigger no one sees coming. It is the same deception every generation falls for, the belief that prosperity equals stability and that this time, somehow, the rules no longer apply. Here's the uncomfortable truth. The greatest financial losses in history didn't happen because people were reckless. They happened because people were late. Late to recognize the pattern, late to understand the signals, late to realize that markets don't collapse suddenly, they collapse quietly first. And that raises a disturbing question you need to sit with as we continue. If the same pattern always appears before disaster, why does almost no one recognize it until it's already too late? History doesn't repeat itself, but in finance, it rhymes with ruthless precision. Long before modern stock exchanges, before central banks, before digital money, civilizations learned the same lesson the hard way. Currencies do not collapse suddenly. They decay slowly in patterns that look harmless until they are irreversible. In ancient Rome, silver coins once held nearly pure metal, but as empire expanded and wars multiplied, emperors quietly diluted the currency. Each new coin looked the same, felt the same, and was accepted the same. At first, no one noticed. Markets stayed calm, trade continued, prosperity appeared intact, but beneath the surface, trust was being eroded, fraction by fraction. By the time citizens realized their money no longer held value, inflation had already hollowed out the empire's economy. Rome didn't fall because of barbarians. It fell because its money failed. Centuries later, the pattern resurfaced in Renaissance Europe. Spain flooded the continent with silver from the New World, believing abundance equaled wealth. Prices soared. Productive industries collapsed. What looked like prosperity became stagnation. The empire that ruled the world bankrupted itself, not once, but repeatedly, because it mistook monetary expansion for strength. Fast forward to the 18th century. France, drowning in war debt, embraced paper money under the promise of innovation and growth. The public celebrated, markets surged, confidence soared. Then the currency collapsed, wiping out the middle class and igniting the social pressure that would eventually explode into revolution. Once again, the warning signs were present long before the outcome was inevitable. The uncomfortable pattern is this: societies don't collapse when money is tight. They collapse when money becomes easy, abundant, and detached from real value. Every great financial breakdown begins with reassurance, with experts declaring stability, with institutions insisting they are in control. And here is where the past stops feeling distant, because for the first time in history, every major economy on Earth is running the same experiment simultaneously. Never before have governments expanded money, debt, and credit at this scale. across this many nations all at once. The illusion of modern complexity makes us feel safer than the ancients, more advanced, more intelligent, more protected. But Rome had engineers, Spain had silver, France had innovation. Every era believed it was different. Every era believed collapse was impossible until it was. So here's the question history forces us to confront before we move forward. If every civilization that ignored monetary decay believed it was too advanced to fail, what makes ours any different? Financial collapses are often described as failures of markets. That's comforting because it suggests no one was really in control. But history tells a far more unsettling story. Before every major crash, there is a quiet transfer of risk from those who understand the system to those who trust it. In the early 20th century, America's financial power didn't sit in public institutions. It sat in private rooms, among families whose names never appeared in newspapers, yet whose decisions shaped markets. The Morgans, the Rockefellers, the Warburgs. While the public was encouraged to celebrate endless prosperity, these families were already repositioning. They reduced leverage, they raised cash, they acquired tangible assets, and when the crash came, they didn't scramble, they expanded. This pattern repeated itself in 2008. Publicly, banks declared confidence. Privately, they dismantled exposure. Goldman Sachs bet against the very mortgage securities it sold to its own clients. Hedge funds quietly shorted housing markets, while pension funds were told everything was stable. Executives sold personal stock while reassuring investors on television. The crisis wasn't a surprise to them, it was an opportunity. Here is the uncomfortable truth most people never hear. Markets do not crash evenly. The losses are socialized. The preparation is private. By the time fear reaches the public, the most informed players are already insulated. Today, the same silent choreography is playing out. Corporate insiders, CEOs, CFOs, board members are selling stock at rates not seen in decades. Family offices are shifting capital into hard assets, private credit, and offshore structures. Large institutions are increasing cash allocations and buying downside protection, even as headlines celebrate record highs. Meanwhile, retail investors are doing the opposite. Retirement contributions flow automatically into index funds. Passive investing concentrates capital into the same few assets. Confidence replaces caution. Participation feels like safety. But participation, at this stage of the cycle, often serves only one purpose: to provide liquidity for those exiting quietly. No announcement will ever be made. No warning will ever be issued. Because the system does not reward transparency, it rewards timing. Those closest to the financial machinery always move first, and they always move silently. Which leads to a question few people are willing to ask themselves honestly. If the most informed players are reducing risk, while the public is encouraged to stay fully invested, who do you think the system is designed to protect? This is the most dangerous moment in any financial cycle, because on the surface, nothing appears wrong. Markets remain elevated, volatility feels contained, confidence replaces caution, and yet, beneath the calm, the very mechanism that allows markets to function is quietly disappearing. Liquidity is the unseen force that keeps the financial world alive. It is the ability to buy and sell without disruption, the cushion that absorbs shocks before they become crises. When liquidity is abundant, markets bend. When it vanishes, they break. History is unambiguous on this point. In the late 1920s, the Federal Reserve tightened credit to slow speculation. Rates rose, money became scarcer. At first, markets ignored it. Prices kept climbing. Optimism remained intact. Then, when selling finally began, buyers simply vanished. Prices didn't fall gradually, they collapsed because there was no liquidity left to stop the descent. The same dynamic unfolded in 2008. Interest rates rose, credit conditions tightened, housing prices stayed elevated, stocks remained strong, confidence prevailed until bear stearns failed, then laymen. In a matter of weeks, liquidity evaporated. Markets fell not because people panicked, but because there was no one left to take the other side of the trade. Today, we are watching this process unfold again, only faster. Interest rates have risen at the sharpest pace in decades. Central banks are draining liquidity through quantitative tightening while publicly declaring stability. And yet asset prices remain near historic highs, convincing many that this time the system is resilient. But cracks are already visible. Banks have failed not because of bad loans, but because rising rates destroyed liquidity. Emergency programs have been deployed quietly to prevent contagion. The Treasury market, the backbone of global finance, has shown moments of stress that would have been unthinkable a decade ago. When the most liquid market on Earth begins to malfunction, it is not a warning, it is a signal. This is the tipping point phase, the moment when confidence remains high even as the system loses its ability to absorb shock. It is the calm before the collapse, not because people are unaware, but because they are reassured. And this brings us to the most unsettling question yet. If liquidity is already draining while markets remain elevated, what happens when selling begins and there is no one left to buy? Every financial collapse is remembered for its trigger, but the trigger is never the cause. It is merely the spark that ignites a structure already soaked in fuel. By the time it appears, the outcome is no longer preventable, only survivable. In 1929, it wasn't speculation that ended the market. It was fragility. A minor financial shock in Europe forced capital to move. Selling began, liquidity vanished, and a global depression followed. In 2008, it wasn't subprime mortgages alone. It was leverage, concentration, silent exits, and drained liquidity. Lehman Brothers was not the reason the system collapsed. It was simply the moment everyone realized it already had. This is the great deception of every cycle. People search for the cause when the conditions have already sealed the outcome. The trigger could be geopolitical, financial, political, or something so small it barely makes the news at first. The more fragile the system becomes, the smaller the event required to break it. What matters is not what the trigger will be, but that one is inevitable once all prior stages are in place. And for the first time in modern history, debt, concentration, insider exits, and liquidity stress are all present at once on a global scale. This does not mean panic, it does not mean abandoning reason, and it certainly does not mean hiding from the future. The people who suffer most in financial resets are not reckless, they are unprepared. They trust that someone will warn them, that institutions will step in, that markets will recover before consequences arrive. They never are warned, they never are protected, because financial systems are not designed to preserve comfort, they are designed to preserve power. History draws a sharp line between those who survive upheaval and those who are consumed by it. Not intelligence, not optimism, awareness, the ability to recognize patterns before they become headlines, to position before the crowd moves, to understand that stability is often loudest just before it disappears. So the final question is not about markets, it is not about timing, it is about responsibility. When the next trigger arrives, and history says it always does, will you recognize it as a surprise or as confirmation of a pattern you already understood?